I'm Michael Welchel, CEO of Big Path Capital, and I'll be moderating this discussion today. I'm excited to be joined by Ken LaRoe, founder and chairman of Climate First Bank, and Paul Moinister, founder and executive director of TOPO Finance. I'm very interested in this topic of where your money sleeps at night, really for a number of reasons. First, I'd say there aren't too many unknown ideas out there. With social media, ideas travel so fast. But this has to be one of those few unknown ideas. And we'll talk more about, what I mean by that. I think it is fair to say that it is scandalous that more people don't know about this topic, given how much potential change it can create. I think the second reason I'm interested in it, all generations get this. And once they kind of hear it, understand it, and they're thankful to know about it. And just want to give you one example. I told my daughter, who is in college, about this. And once she did her own research because she doesn't believe in old dad, she came back to me and said, Dad, I feel like I've actually found gold. I feel like I have gold in my hand, verbatim. And she's not one to over dramatize, and she's not easily impressed. And so her reaction, I'd say, is almost, it was some with a evangelical fervor, I think demonstrates how valuable and concrete it is to her. And I think in her generation, I think there is a lack of agency about how to affect change in climate. And so this is a potent action. And now she tells her friends about it, and they jointly marvel why they didn't know about this earlier. It's hopeful. It's an action that each individual can make. So who thought that talking about cash and banking could be this much fun and mysterious? So that's why I'm so excited. Short context on Big Path. We were founded 18 years ago with the mission to change how capitalism is done and to show how capitalism can be a force for good. We were one of the first 60 B Corps that were certified back in 2008. And so we are an investment bank that works with impact companies and funds to help them raise capital and also execute mergers and acquisitions. First, I'm going to go ahead and just give a little introduction to the other panelists, and then I want them to talk about their personal journey and kind of what brings them here today on this topic. So first, Paul Moinister founded TOPO Finance, which is a nonprofit which helps individuals and organizations strategize how to leverage their cash assets to be a positive impact for the climate. And so in Paul's intro, he's going to talk a little bit about his personal story and what brought him to starting and founding TOPO. Ken LaRoe founded Climate First Bank. This is his third bank he has founded, and they are currently the fastest growing new charter bank in the U.S. There are 4,000 banks out of there, and they're the only one can say that. So it's a pretty monumental accomplishment that he and his organization have achieved. One aspect that I think on this topic that also I found surprising, having been in, call it impact finance for 18 years, that it wasn't really until working with Climate First that this idea that cash can have such a large environmental and social impact. And for me, it just wasn't on my radar. It really, just to be honest, it didn't register. So part of this is kind of to be, if you're like, had my experience of kind of bringing this topic out into the light. So we're in for a treat. We've got two great perspectives to illuminate this topic. So Paul, will you introduce yourself and kind of take us through some of your personal journey?
Yeah, thanks, Michael. Appreciate the introduction. And there's a sort of fun irony in the intro of like, this is the most exciting idea you've never heard of before, which is that it is neat to be working on something that's on the forefront and that is this new body of knowledge that we're bringing into the world. But at the same time, a bit frustrated that it's still this thing that's so under the radar. So really appreciate all the work that you're doing and all the work that Ken is doing to help shine a spotlight on this issue. And my journey to this world was a little bit like yours, Michael, in that I spent about 15 years working and studying in climate before I ever really started to understand the role that finance plays as this invisible hand of the climate crisis. But more importantly, the possibility that finance can also play this visible hand of climate progress and increasing social justice. And so my background is actually I started my career working on Capitol Hill. My expertise was sort of in fighting these big mega projects. I worked for a congressman from Memphis, and I was sort of known as the Keystone guy back in the day because I led the congressional opposition to the Keystone XL pipeline, like way back in the early days before it was really on the national radar. And so I have this sort of, joy of getting to find these things and bring them to light. And so I sort of see this finance as kind of the latest iteration of that. But what was interesting back then is that I was working on this in this very non-systemic approach of like, how do we stop, this coal mine or this pipeline, et cetera. And nobody had, I knew about divestment. I knew about, that there were things happening in the climate finance space, but it wasn't until I started talking to Bank of the West, just like very coincidentally, met them at an event and started learning about the role that banks play taking your deposits and then putting it out into the world, that I started to really start to like think about like how has nobody ever told me this before? How have I gone 15 years studying in climate, getting a master's degree in environmental resource management? Nobody's ever told me that this is the case. And I started talking to a bunch of my friends across the climate space and found that this was kind of the exact same thing. And so we set out to figure out both why that was the case and how do we change that. And in 2021, we just sort of started asking the question like, well, if Bill McKibben's telling me, Paul, that where I bank matters, and I'm run a small nonprofit and unfortunately don't have very much money, my few $1,000s in the bank matter. But what does that mean for big companies like Apple, Microsoft, or Google that have over $100 billion in cash and investments? And since this was the middle of the pandemic and I had nothing better to do, and I'm kind of a nerd, I spent a bunch of time pouring through the sustainability reports of these companies and noticed that there was nothing in there about banking or investing at all, that they had these massive climate commitments. And at that time, we were in a very different place and they were really ramping up those commitments. Nothing was in there about that. And so we just started to set out on the question of like, could we evaluate the emissions that stem from this banking and investing? Could we tie it back to these companies' overall climate performance? And most importantly, like, can we get these big customers who have hundreds of billions of dollars in capital to start both leveraging their influence within their existing banks to push their banks towards better policies? But also, you look at a company like Microsoft, they have this $1 billion climate innovation fund, which is this great impact investing hub. But meanwhile, they have $130 billion at the time in their corporate treasury. Like, what is the impact of that? And it turns out by doing the math, and we developed a novel data and methodology for doing these calculations, we were able to find that for the largest companies in the world, like Google and Microsoft, their banking and investing was actually generating more emissions than everything else they were doing combined, including the use of all of their products. And then when we went and started talking to these companies, none of them had any idea what we were talking about. And so for the last 4 years, we've been sort of pioneering this field of applying a climate lens to your financial management. And to be clear, like we talk about cash and investments, this is sort of your corporate cash and your investments. So we look at some equities, but it's a lot of like fixed income products like your bonds and corporate debt securities, et cetera. And where this gets really exciting is that it's finally starting to take hold, and we're starting to see more and more companies and more organizations. And it's not just the case as we've done the data on this. It's not just for companies. It also applies to everyday individuals, and we'll get into some of the stats around that. But it's this really new and exciting world where we've been sitting here trying to figure out how are we going to finance the climate transition. And meanwhile, we've been sitting on the money all along, just not paying any attention to it because we've just been putting it in the bank or investing it in the market and never thinking about what world is it creating. And so it's a really exciting time and really appreciate the opportunity to be here today and share it with the audience.
Thanks, Paul. Ken, could you go through kind of your personal journey and like especially taking us through the different startups and then kind of where you are today, kind of in a really, I think, interesting position with Climate First.
Sure, absolutely. Uh, Thanks, Paul, for that intro, and it just makes me want to launch off in so many different directions. But um, I still live in the small town I was born in Central Florida, 4 miles from the house I grew up in that my dad still lives in. And it was very rural when I was growing up, and we had a small farm, and that sort of thing, and I love to hunt and fish. So I developed a real love for the outdoors at an early age, not really even knowing what that meant or what environmentalism was or anything else. Um, and then fast forward into my adult life, I pretty much started out, a relatively conservative mindset, got a degree in business, and like a lot of baby boomers, just wanted to get out and make a bunch of money, and um, did, and progressed and got into banking quite by accident, and then decided to start my own bank, which I did in 1999. It was a Florida start it, scale it, sell it model. Make everybody a bunch of money and move on. And we did, and it worked, and it was the perfect timing and all that stuff. And um, my wife and I got a mini motorhome. And we circumnavigated the country, and before we left, ironically, my brother, who's um, a conservative guy, let me just put it that way, gave me Yvon Chouinard's autobiography, Let My People Go Surfing. And I read that on the trip and thought, oh my God, this is it. This is at 50 years of age. This is what I need to commit the rest of my life to. And all I know is banking. So how can a bank actually help the environment, which, at that point was truly climate? How can a bank help in the climate crisis? And so just started studying it and came up with the name First Green Bank, and we launched and opened in 2009. That one wasn't the scale it, sell it thing. At least that's not what we wanted to do, but that's ended up what happening, with a lot of shareholders that got really antsy and wanted to sell. And so we sold the bank, and it was exceedingly unfulfilling, for all the right reasons, including all my sharp young people who no longer had jobs because they were all fired and all that stuff. Um, Another cross country trip and another um, I don't even know how to put it, another decision that resulted in a cascading series of events was Climate First Bank. And my wife came up with the name and said, it's got to be that name, because it's got to be in your face, wear it on your sleeve. This is what we're all about. We're no compromise. And from my last bank to this bank, we've been heavily involved in the Global Alliance for Banking on Values. And um, since 2009, and that was when they actually formed. And Paul, as you know, you've probably read a lot of the work. There's some good work that has come out of the GABV and some of their studies that they funded, but I don't believe anyone has put it in understandable terms like you have, and the impact that even a consumer can have. We all thought, well, we're where your money sleeps at night. If you bring it here, it's going to do good. And it was that nebulous good. It just wasn't quantified. And I am so thankful for you. You're feeling like it's not out there. Why doesn't any more people know it? But nobody would know it were it not for you. So you've got to take that away and know that it's the start of a movement, and certainly a start of thought leadership that's being headed by you. And I want to thank you again.
Thanks.
That's a,
That's all.
that's a great, really great point. And we will be able to share some of the research so you can look at it. But I wanted to use one anecdote just like to put a point on it, because I think this is where it is like it's kind of mind bending. So if you take 100,000 based on the research that Topo's done, this is just kind of one anecdote to make it real. Say if you take, and I'm going to use, let's say, $25,000. If you take $25,000 and you move it from one of the big banks, traditional banks, to one of these values-based banks, that is the equivalent carbon reduction of not taking 25 cross-country flights annually, right? So and I think McKibben kind of talks about this, is that your cash sitting in a bank probably has more of a carbon impact than any of your other activities, including travel. So that's just like, it's almost like when I heard that, I was skeptical. I didn't believe it. It's like, how can something as passive as cash sitting in a bank have that much of a carbon impact? So, Paul, could you just just kind of help us in a big picture standpoint? How does that like make sense?
Yeah, no, and I mean it's funny, Michael. I mean, you're not by any means alone, and we talk to folks every day about this. And when we say, whatever the version of that stat is, and they say, "Well, how is that even possible? Is it because of all of the, banks and all of the energy that they're using for their electronic banking and all that?" They never even think about the fact that and I'm not just talking about everyday people. I'm talking about corporate treasurers of some of the largest companies in the world. And so it's like we have this tendency to think of this bank as this black box. We go and we put our money in the bank, it just stays there. But in reality, that black box is the invisible hand of the climate crisis, and it's just been sitting there hiding in plain sight this whole time. And so the reason that those emissions exist is because, as Ken can tell you, banks take their money and they deploy it into the real economy. It's not just sitting there, and they take it, and depending on how the bank is structured, around 90% of that money that's being deposited is lent out. And for the world's largest, most carbon intensive banks, like your big Wall Street banks and your super regionals, on average, about 20 to 30% of that money is being lent to the world's most carbon intensive industries. And so it's being lent to oil and gas and mining and like big, heavy industrial manufacturing. Some of these things are things that we need. Other things are things that like need to evolve and change, but all of them need to be sort of decarbonized. And so what ends up happening is that for every $1 billion that banks lend out, it's generating about, for the biggest Wall Street banks, it's generating about 300,000 tons of emissions per year. So that's the equivalent of about 65,000 cars annual emissions per year, as opposed to a bank like Climate First Bank, and Ken can certainly talk more about what they're doing, but their lending is much more, even for banks that don't have a real climate lens to them, they're lending to mortgages and small businesses and other things that are much more have a much lower carbon footprint. And if you're a great bank like Climate First Bank, you're really trying to ramp up your lending to solar and everything else. And so the emissions difference between a big Wall Street bank and a bank like Climate First is going to be about an 80% emissions reduction. And so important to note that these are like indicative emissions and that these are sort of the scope 3 emissions. So it's not something that you can directly control the way that you might be able to control other parts of your emissions profile, but it's a really, really, really big component of your emissions profile. And important to note too that this isn't unique to cash. It exists. Every dollar as it moves through the financial system has a carbon footprint, and that carbon footprint will be determined by how that money is being deployed. And so, if it's being deployed into a municipal bond, it has a big carbon footprint, depending on what it is. If it's going to put solar panels on a school system, like great. If it's going to build highways, it's certainly going to be a lot more carbon intensive. And so, this is true sort of throughout the system. And so, a lot of the work that we do initially, and I should note that we do this work of tracking it just to sort of do the illumination of the like, so what do you do about it piece. And so a lot of the work that we're doing on the tracking this is to be able to shine the spotlight on this and be able to show the value of the better alternatives, but also the need to create these new alternatives. Because part of the interesting challenge is because we're sort of, if you take the EV analogy, we're basically in the like 2010 2012 range, where like there are some that are available, but they're oftentimes like subscale or not very good. The infrastructure is not there. And so if a company like Apple said, we want to green all of our banking tomorrow and all of our investing, they couldn't because the products don't exist. And so we're at this also interesting and exciting time of really needing to show that strong market demand and that market signal to be able to catalyze the innovation for greener alternatives. And that's part of the value of what Climate First is doing, as the fastest growing bank in the country, is demonstrating that that demand is there for better, greener banking.
So Ken, can you that point that, picking up that point that Paul made, that it's not at all about the bank's kind of like, call it internal carbon footprint, but it's about how they're using the deposits. Can you talk a little bit about that, about how a bank uses the deposits? Because I do think that's really important for folks to kind of get their heads around.
Absolutely. But before we do that, to go back to the bank's internal operations, there is probably a distinction too. Paul, you probably know better than any of us, but hardly any of the large banks do anything about their energy consumption. For instance, all our buildings are LEED certified. We strive for LEED Platinum. All our buildings, well, most of our buildings are powered by solar. And then if you look at the Global Alliance for Banking on Values member banks around the world, they bias towards that also. They're all interested in making their buildings more energy efficient, and they're all interested in producing their own power. But Michael, to your question is how do we deploy the money? I think the first thing is how does a bank work? And a lot of people don't understand that either. And the easiest way I can think of to think about it is the money you deposit with us is our raw materials. We take those raw materials and we turn them into our finished goods, which are loans. And where we loan the money has a huge impact. And that's basically where what all this comes back to. If you deposit your money, I'll speak to us, Michael, just because I don't know what any of the other, GBV banks are doing as an example. We have a very, very robust consumer solar loan program. It is the best in the country for the consumer because we don't charge dealer fees like all the fintechs do. We launched that product. We wrote all the code for it. We launched that product in May of 22, and we've done, I think at last count, $185 million in that product. That's 3,700 homes we've put solar on. That's to us, that's a big number. Maybe the whole country, it's not a big number, but it's going to be a big number for us. We're now licensed in all 50 states to do that product. We're developing a product right now for we call home hardening and home sustainability. There'll be windows, roofs, HVAC, insulation, that sort of thing, where people can readily afford that. Um, but we also don't want to, and we do a lot of large scale solar, renewable energy and battery storage stuff. But we also don't want to forget the other stuff we do, like you were saying, Michael, lending into the real economy, and not. We should probably make a commentary on Florida House Bill 3. In Florida and some other states, the legislature has come in and not allowed any bank to not bank an industry. Um, so you can just take that comment and run with it, and read between the lines. But everything we do is looked at through the lens of where your money sleeps at night.
So for those who may have joined us kind of as we already started, we're going to go over for about another 10 minutes and then for this moderated piece and then turn it over for Q&A. So think about the questions you might have and feel free to kind of put those into the QA box at the bottom, and then we'll kind of pick those up. So I wanted to talk a little bit about you know I guess we talked a little bit about, I think I got a better understanding of so you banks take customers, companies' deposits, and that becomes the raw material to then produce the loans. And so you could see, hey, if Climate's First is doing a bunch of like solar lending, and then you've got on the flip side a large traditional bank that's doing a lot of high emission carbon industries. That's kind of where you can see where that difference comes up. I'm curious, are there any, and this is for both of you, with banking with a values-based bank, say the benefits, are there risks involved? I mean, do I get the same kind of insurance that I would get with the big bank? I mean, what are there, I see the benefits, but what about potential risks?
Um, there's really, I just want to be really careful. There really is no inherent risk with banking with a small bank unless your deposits exceed the FDIC insurance limit. And then you'd have the same risk as a big bank, and that's $250,000 per account titling, but you could stack them up and get like up to $1.8 million or $1.7 million worth of FDIC insurance coverage by, as an example, doing a joint account with your spouse, doing an individual account, then another individual. So you can see how it can just really get a lot of coverage. But arguably, banking with a small bank that has an emphasis on sustainability is probably safer from the bank's perspective because we don't have stranded asset loans. We're not making loans to fracking companies or companies that rely on fracking companies, that kind of thing, or sell to fracking companies. So there could be an argument that a values-based bank is actually safer and sounder. And we operate under all the ESG principles, and G being extremely important because that's governance. And um, gosh, I mean, just about
Here's a
all the small banks I've ever seen have really good governance.
Yep. Here, a follow-up question would be, in the US, how many GABV, Global Alliance for Banking on Values banks are there? Roughly, if I want, hey, I want to go move my money, test this out. How many choices do I have out there in the US?
It's either 14 or 17. I don't,
Okay, all right,
for
no,
the life of
good.
me,
All right,
I don't, for the life of me, know why I can't remember, but
I was
um,
going to say 16, so I was somewhere in between there. But
not two.
yeah,
the, the relatively good news is that, I mean, there's about 4,000 banks, a little over 4,000 banks in the United States. And once you get just from, if you're looking at it in terms of purely from exposure to the world's most carbon intensive sectors, and so you're talking about commercial lending to oil and gas and really destructive industries, once you get out of the top 20, you see a really big drop in terms of that exposure. And once you get down into banks that are really under $20 billion in cash and investments, almost none of them have any real material exposure to those industries unless they're, maybe in a state like Texas or something, they are to smaller manufacturers. But there's not a lot of banks that are lending this type of money because it requires being such a big bank to fund these. I mean, these projects are costing more money than a lot of the GABV banks have combined, right? I mean, Citi underwrote a $60 billion purchase for Exxon last year. And so the size of these things requires it being the world's largest banks. And so when you get out of that sort of, those top 20 banks, like you're in pretty good shape as far as at least having around half the emissions and a lot less exposure.
So I think of kind of like, I don't know if you remember the divest invest movement. It's all, I mean, I almost like put it in that kind of terms. Like if you take your money out of one of these top 20 really huge banks, that's kind of like the divest, right? And it doesn't matter who you put your money with, as long as you kind of get it out of those 20. And then maybe like the invest side of actually doing positive would be moving it not just to not one of those 20, but you move it into one of these 15, 16 banks that's kind of has a more positive screen to it. So it's like at least, I mean, I think that's kind of interesting. The big message is at least divest, right? And then, then explore whether you want to invest. So I think that's a really good, I think a good, you kind of a distinction between the two. So I think we got maybe one more question before we open it up to the audience. Um, I think one when I'm just kind of curious, like Paul, when you were like thinking about this, was there any kind of indication on the front end before you did the analysis that you felt that cash could have this as large of a carbon footprint, or was it more out of just curiosity to explore it?
Yeah, I mean, we knew it had there. I mean, once again, not being an expert on this and not having really dug into this too much. My colleague James, we sort of started working on the math together, like I knew that there was a big, that there was a lot of emissions tied up in it. How much we didn't know when it came directly to the companies themselves. And so I'll never forget, I was sitting at my desk back in my old apartment in Seattle, and we started talking about this, and we were looking at Apple. And some article had just come out about how at that time companies especially had even more cash. And so, there was 10, 12 companies that had over $1 trillion in cash. And we just like sort of looked at that list and we were like, well, what are we talking about here? And I remember asking him, I was like, are we talking about 3%, 5%? And for Apple, and we started running the numbers, and he just did a back of the envelope calculation, and it was 50%. And we were like, holy, like
Yeah.
this is really something. And then as our math got better and our emissions data got more precise, we actually realized that it was actually over 100%. So the last time we looked at Apple, I think it was around 115, 120%. And so, that percentage is, I should note that that carbon intensity is sort of continuing to go up, and we're just kickstarting another analysis of the banks, and we expect the carbon intensity to go up even higher, because as the emissions collection data gets higher, the average carbon intensity gets higher. So per dollar, the emissions are going up. Like when I say 115% of Apple's emissions, that's a combination of like how much money they have, what assets it's in. So like it's less important to look at that percentage as opposed to just like the actual, the carbon intensity per dollar and what that money is being directed to. But so in short, no, we had no idea that it was going
Okay.
to be this big. And it was kind of one of those things. And, we've been really fortunate to work with Bill McKibben, who credited us with uncovering the largest source of huge and hidden carbon emissions left in the economy. And like when we started out on that, like we definitely didn't think that that was the case, that we were finding this thing that was that big. And when, we've started looking at different cuts of the data. And if you look at corporate cash and investments in the US, it's around $7 trillion cumulatively last time we looked. And that is generating about what represents about 20% of all emissions in the US. And when you look at the world's largest financial institutions, so if you look at just the 10 largest banks and 12 largest asset managers in the US, their cumulative carbon footprint is about, would be, if it were a country, it would be the third largest emitting country in the world, just behind China and the US. And so it is really staggering, the scale of all of this. But what's exciting is also the scale of the opportunity in that. And so, I tell this story a lot, but it sort of represents the power of the solution, whether you're an everyday individual who's doing the right thing, or you're some of these companies that we work with who have started switching their banks. Like whether you know it or not, sometimes this stuff can be even more effective than everything else that you've been doing while you've been working tirelessly to reduce your emissions and green your buildings and put solar panels on your roof. And then meanwhile, you're just like, as the name is titled, while your money is sleeping at night, it'll oftentimes undo the positive impact that you're actively working to create during the day. And so being able to unlock that power is a really exciting and inspiring opportunity for folks. And especially in this moment, arguably maybe the most high impact, low cost, if not revenue generating. I think it's important to note, can your interest rates at Climate First, or you can make a lot more money putting your money in a checking account in Climate First than you can at a Wall Street bank as well. So you can make more money, reduce your emissions by 80%. And there's not very many things you can do that with right now in the world.
Yeah, I did. I checked, this is a few weeks ago, but checked like American Express, they have a high yield cash account, and compared that to Climate First's money market. And, Climate First was a good bit ahead of higher yield than Amex. Here's a good question. We're opening up for questions, and questions come through. Wanted to kind of to pose to either one of you. I think this is a good one. In times of economic chaos, how do you keep this in front of mind of consumers and organizations? How does this not, in the grand scheme of things, how do you position this in a way that it matters in the times that we're all living through right now?
Yeah, I mean, I think obviously, like I had a meeting the other day with a bunch of corporate treasurers from Europe, and all of them were late to the meeting because they were all pulled last minute into meetings with their CFOs. And so, right now with the current market turmoil, like honestly, just sort of keeping your head above water is honestly sort of first and foremost among, of all the things that need to be happening here. That said, what's interesting about this work and what folks, the best spokesperson for what companies can do around this is Charlie Bischoff, who's the treasurer of Patagonia. Not surprisingly, Patagonia, back in 2018, Yvon Chouinard and the Chouinard family came to the treasury team and said, we're doing all this work to fight all these pipelines and doing this thing. We don't want our money to then be flowing and through our banking, actually investing in these projects. And so the treasurer, Charlie, set out on this project, and he's been working for the last 7 years. And what he's actually found is that by aligning their banking and investing with their climate values, they have not only been able to reduce their financial risk, they've actually increased their returns and materially impacted their emissions and their exposure. And so there's this big piece of this where, yes, in this current moment, like we're doing everything that we can just to like stay afloat. But once you get to shore, corporate treasurers are finding that this is actually a really good strategy for insulating yourself against long-term climate risk. It's good in terms of figuring out how to maximize your returns as well in the near term. And so there's some pretty interesting ways, and we're finding the more that we lean on that side with treasurer and speak like treasurer language and less around the like reduce your emissions, we're finding a really receptive audience because the financials make sense too, not just the impact part.
And how about you? I mean, I know that to grow like you're growing, you've got to get the deposits coming in. So how are you trying to figure out like in this, you're trying to keep this on top of mind of folks?
Well, I mean, like everything in life, sales solves everything, and the way to increase sales is marketing, and we just got to keep the word out there. And we're working with Paul on some initiatives also that would tie the bringing deposits to us because we need them to keep growing, as well as know what your deposits are doing. And we've been doing a lot of that in our advertising pre-Paul, but after we get everything put together with Paul, we'll do some more hard hitting stuff.
All right. Um, so here's one. What is the panel's perspective on the impact and potential of collective action versus individual company shifts? So in other words, what's the value of companies collaborating on this? Do you know of any networks or industry collaborations happening on climate-friendly finance, or is this a gap?
Um, it's a great question. So there's a couple of issues with the collective action piece of this. First is that banking is a very private activity, and so a lot of large companies don't like to necessarily share who they're banking with. And so it makes the collective action piece harder. The other big problem, to be very honest, is that in this current moment, there's a lot of anti-cartel. Not that this would be a cartel, like by any definition that any of us normal people would describe a cartel, but things like the Net Zero Banking Alliance and the Climate 100, which were these big international alliances that all of these banks were joining, were basically deemed cartels by sort of the Trump administration. And so there's been a lot of pushback on this sort of collective action efforts. And so I can say that we're working privately behind the scenes in a non like anti-competitive way with these companies to help them do this. And part of the effort is actually getting them to learn from each other. And so there have been instances in the past, I should note, that like back in the early days of some of this work in the early 2020s, a lot of outdoor companies went and met with Bank of America to talk to them about some of their financing of stuff. But aside from that, it's actually a lot more sort of peer-to-peer collaboration, and being able to share lessons around like when we engaged with our banks, what did we learn, what did we push them on? And so it's a bit more of these peer-to-peer networks, and we're working on building those in both the US and in Europe. And so they're sort of growing pockets of this stuff. I should note as well, also, since Kylie's on this call, B Lab did put together a great group of companies that were working on pulling this together. So if you're part of the B Corp network, that is a really good opportunity. And Kylie, who's on this call from B Lab, would be more than happy to, I'm sure, to talk to you about all of that incredible work that they were doing. And I know Climate First was really involved in that. And so if you're a smaller company, a B Corp, there's a really great outlet there. If you're sort of not in that world, come talk to me, and happy to help point you in the right direction and help.
We got one comment. This is like they support Ken's. He's not giving fake news. So my colleague Stefan at Trip Zero recently financed his home solar system with Climate First. He had a great experience. Even the economics of the deal were the best he'd seen. So there you go. No dealer fees.
Well, yeah, thank you, and that's intentional too. By the way, we really want to have the best for consumer product. Our mission is to make our shareholders money, of course, but our mission is to draw down atmospheric carbon, and it's almost one of those whatever it takes kind of things. So.
So here's I think this is a really interesting question. So this is from Julie Lorenz. So we've talked about this idea of like moving money from a big bank to a smaller bank, values-based bank. So, so you're not, using your deposits to be then used as a loan to say a bad company. But what about reducing the emission output by the large companies? So it's a different part of the value chain, but I think it's a good question.
Yeah, most of the work that we do actually is around helping large companies engage with their banks to improve their policies, and so and improve their product offerings as well. And so there's there's sort of two sides of this coin, right? Which is that we, as much as I would love everybody in the world to move their money to Climate First Bank, like that's not going to happen. And especially for the big, large, I mean, I talk to companies that sometimes work with over 4,000 banks. Like that, this is not a sort of single point solution. And so, especially if you're a big company that needs to work with the world's largest banks in the US and Europe, you will have some choice differentiation, and there's some that perform better than others. But the goal is to also get the world's biggest banks to become the most responsible banks as well. We want Chase to start looking a whole lot more like Climate First in terms of its lending portfolio and its values alignments and its transparency and all of that. And so what's interesting is that sort of we tend to sort of frame this to companies as, think of your bank like a supply chain partner. And so companies like, take a company like Salesforce, who Patrick Flynn, who runs our corporate outreach work, used to run sustainability at Salesforce. I met him when we first started talking to Salesforce about this, and he was honestly the only person who was a sustainability lead at a company that was like, hell yes, this is awesome. What can I do to help? And so he's a part of our team now. But when we met him, he was blown away because Salesforce had created all of these different tools. They had created an entire system that a bunch of companies actually modeled their sustainability work around, which is go meet with every supply chain partner, go work with them to help understand what their emissions are, go work with them to understand why their emissions are higher, how you can reduce them, what they can be doing, downstream to reduce your overall emissions as a company. The one exception to that is they have never gone and talked to their banks, and they had never thought of their banks as their supply chain partners. And so that relationship has existed entirely outside of the sustainability footprint. And so what companies are doing now is actually starting to take the model and just treating their banks like any other supply chain partner. And so what that means is they're going and engaging with their banks, they're demanding more transparency, they're looking for better products, they're asking them, what can you do? What is your trajectory? How is our business aligning with yours? And there's a bit of both carrot and stick here in terms of, great, if you improve your performance, if you start offering us better products, like we'll move more of our business your way. We'll reward you by buying these better products. If it's not the case and they're not a great partner, then maybe they move some of their business to one of their other banks in their portfolio that is performing better. And so there's this really interesting opportunity here to leverage the engagement side of this. And what I can tell you is that, ironically, the states like Florida and others who have been so big on pressing the world's largest banks and asset managers to stop doing woke capitalism, the amount of money that's cost the banks is like less than all of the like money that Microsoft alone has in their pension funds with BlackRock. And so the scale of the impact that we can make in terms of leveraging that corporate voice. I mean, last year alone, we engaged with companies with over $500 billion in cash and investments. If you start throwing that, we're talking about 100 and, something $1 trillion financial system. So there's a lot of money at play. But if the Microsofts and Apples and the Googles of the world start telling their banks, we don't love what you're doing, they're going to wake up and pay attention to it.
That's great. Yep.
Yeah, my comment is it's a long game. It really is a long game for driving up the cost of dirty energy, which would help reduce it, as well as shaming the banks and then hitting the banks with your pocketbook.
Yep. Yep. You start switching start to get more of that money where you're kind of pulling away that raw material. I mean, you're literally pulling away the raw material that they need to do to go make their loan. So you affect their ability. It's got to be on a bigger scale than it is now, but you'll begin to affect their ability to do their business, which is great. One thing I wanted to mention, we're coming up about 10 minutes before the hour. We're going to put in the chat a link where you can just, if you click on it, it's basically a survey. and you can click if you want to get more information on Topo and or Climate First. So you can pick one or the other or both, and then we'll follow up with some more information post that. That's going to be coming in the chat here just shortly. Another question. This is from Michelle Hearens. She was like, I'd love to know of any toolkits to share this information more widely. So is there any kind of, ditch your big bank, switch to values-based bank? There used to be move your money, any movement or any materials that can be easily, disseminated to a wider group of people.
Yeah, so we built a calculator. I can drop it in the chat here, but it's topofinance.org/calculator. It's an easy tool that you can use to go on and just get a rough sense of, if you bank with a big Wall Street bank, what the carbon emissions are from your banking. If you were to move it to a greener bank like Climate First, what the emissions reduction would be. And then, as Michael said, like how does that compare to flights taken or miles driven, et cetera. So that's one way to just sort of start baselining this. We have a report that we wrote last year called the Carbon Bankroll 2.0. And I can share that as well. And then otherwise, we have a lot of tools that we build that are sort of a little bit behind the paywall type of version. I mean, they're all free, but they're just not publicly available for how we get companies started on all this. So happy to send anybody those materials if you. I'll put my email in the chat too, and you can just reach out to me. And I should mention that we do all of this work as a nonprofit, we do all this work for free with companies, helping them wrap their arms around this problem and starting to understand what they can actually do to start driving impact. So happy to help anybody provide any advice or guidance. Although I will mention, we are not financial advisors, we are climate advisors around finance. And so not financial advice, but happy to give you the climate advice side of it all.
All right,
And
go ahead, Ken.
real quick, I would add to that. It's been a little bit since I've been on the GABV website, but I noticed y'all put the link for the GABV in here. There's some resource materials available in there. And then if anybody wants to reach out to me, and we've got other resources, and there's some great books on this topic also. My email is ken@climatefirstbank.com.
And that's a good point. If you can't get on to the survey and you do want information from more information on Topo or Climate First, you feel free. You can reach out to me. Emails michael@bigpathcapital.com. Here's a good. I think we've got time for a question. This is from Richa Argawal. There seems to be a trend where smaller and regional banks, which may not be values aligned, are increasing their fossil fuel financing as the big six banks are divesting certain assets. How do you think this trend affecting decision making for corporates and individuals? So basically, kind of like the next tier, smaller regionals are flexing and doing some of this climate financing, and how do you see that affecting things?
Yeah.
I think that's a reality. I mean, it's definitely happening, and it's going to keep happening. To me, a little bit of it, or a lot of it, is still the long game. It's putting the public pressure on, and then trying to raise the costs for dirty energy. And the less, it's also a supply and demand thing. The less the big banks are in there, the smaller banks have to charge more, and do charge more. So, Paul, I'll pivot to you.
No, it's exactly right. And I think it's important. Historically, because of the sort of the lens that's been brought into this sort of branch of climate finance, it's been very much around the idea of divestment. But I think it's really important to note that there's kind of three goals here, which is like, one, we need to ramp down investments in fossil fuels. Two, we need to ramp up investments in climate solutions. And then three, we need to fund the decarbonization of everything else, from housing stock to normal businesses that are not that carbon intensive compared to oil and gas, but like still have a big carbon footprint, to construction, all of that stuff. And so, as Ken noted, as the biggest banks get out of fossil fuel funding, and as the question astutely noted, bigger super regionals like Truist and others are actually really ramping up their investments because they're seeing that as a money-making opportunity. That said, as fewer and fewer banks are providing that financing, it's still the cost of capital, as Ken mentioned, goes up, but also the exposure goes up as well, because there are fewer banks or other entities that are willing to purchase those, that financing if you need to get out of it. And so it's also creating a lot of risk there in that. And so I think over time, what you'll see is that some of these banks like Truist, which might be printing money when the sun is shining, are really ramping up their exposure to stranded assets. And long term, it's going to sort of flood the market. But that, once again, the other piece of this is that the more that banks are investing in climate solutions like solar and wind and other renewable energy sources, the cost of those projects are going to go down so much that it's also going to make oil and gas a less profitable piece of the puzzle. And not to mention, there's a huge piece that insurance plays, which we haven't touched on today, which is an important part of the financial piece, which is the role that insurers play actually insuring those projects. And if insurance companies, which are exposed to the most climate risk at the moment, stop actually insuring those projects, then they'll never get the bank financing. And so it's a really important sort of upstream part of the strategy.
Awesome. I think we're gonna pause it there. So everybody give a few minutes back in their hour. Really appreciate everybody joining us. We did record this, and so we will be sending this out, a recording, if you want to share it to a broader audience. But really appreciate this, like I said to begin with, this should not be an unknown idea out there. And I think it is kind of has that, small action, high leverage, and relatively, yeah, okay, it's not, no one likes to change banks, but it's not that hard when you look at the other kind of ideas or potential actions you could take to reduce your footprint to this extent. So thank you, Ken. Thank you, Paul, for spending your time with us and really helping us understand this topic.